Look, I want you to picture this. You've spent years grinding. You paid off every stray bill. You obsessively watched your credit utilization, and you finally did it. You hit the holy grail, a perfect or near-perfect credit score, let's say 800. You feel like a financial genius. You're ready to get the absolute lowest interest rate on that new house or car. But here's the crushing betrayal. When you get to the bank, the loan officer barely bats an eye. You get the same exact rate as the person standing next to you with a 760 score. You realize you spent years obsessing over points that don't matter while neglecting the real factors that actually determine your financial future. You were chasing a number that has a ceiling, and you didn't know where the growth stops. That's just the first lie we're exposing today. We are diving deep into the math and the manipulative psychology of debt and credit. The credit score ceiling. Why obsessing over a score above 780 is a complete waste of time and energy. The debt snowball lie. Why the math says it's a terrible idea, but psychology makes it a brilliant one, and how to combine the two. The 1% rule. The single, rapid-fire metric you need to spot a terrible, wealth-destroying loan before you sign the papers. My name is John, and I spend way too much time thinking about why the systems designed to help you succeed are often the biggest financial traps. If you're someone who feels like you're doing all the right financial things, but still not seeing the payoff, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Let's expose the lies. Here's what most people don't realize. Credit scoring models like FICO and Vantage Score are built to assess risk. They don't care if you're a good borrower. They only care if you're not a bad borrower. And the point at which they decide you're definitively not a bad borrower is around 760 to 780. The shocking statistics. Look at the data from lenders. For a 30-year mortgage, the difference in the interest rate offered to a borrower with a 780 FICO score versus a borrower with an 820 FICO score is often 0 basis points. They are categorized in the same top tier, A-tier risk. Concrete example. Let's say the current mortgage rate for a top-tier borrower is 6.00% APR. 780 score borrower gets 6.00% APR. 820 score borrower gets 6.00% APR. Chasing that extra 40 points costs the 820 borrower time, effort, and possibly the opportunity cost of having their cash tied up in lower return activities, all for literally $0 in savings. The psychology, the illusion of perfection. Why do we obsess over a perfect 850? Because we equate perfect scores with perfect outcomes. It's the same psychology that makes us chase an A+ in school when an A- would yield the same opportunities. It's the desire for absolute optimization. But in finance, once you hit the optimal outcome, the lowest rate available, any further effort is pure waste. What banks actually care about? This is where it gets really interesting. Once you hit that 780 ceiling, lenders switch focus to other, more powerful factors that determine the size and terms of your loan. Debt to income, DTI. Ratio, your total monthly debt payments divided by your gross monthly income. A low DTI, under 36%, screams low risk. Regardless of your score, this is your real financial ceiling. Loan to value, LTV. Ratio, how much you are borrowing compared to the asset's value, e.g., a huge down payment. A low LTV shows financial discipline and protects the lender. Reserves, the amount of non-retirement liquid cash you have saved after the down payment. This shows you can withstand job loss. Actionable step, stop chasing points, start chasing ratios. If your score is above 760, stop optimizing utilization. You don't need to stress about keeping your credit card utilization at 1%. Focus on paying it off in full monthly. Focus on DII. Shift the energy you spent micromanaging your score toward increasing your income, the denominator, or aggressively paying down non-mortgage debt, the numerator. That's where the real financial leverage is found. Part 3. The Debt Snowball Lie, Math versus Psychology. For decades, the financial self-help gurus have preached the debt snowball. It's simple, it's popular, and here's the lie. It is mathematically inferior to the debt avalanche. The math. Why the avalanche? When's the debt? Avalanche method dictates that you focus all your extra payment power on the debt with the highest interest rate, APR, first, regardless of the size of the balance. Example, scenario, total debt $10,000, debt balance APRM, PMT, card A, high APR, $2,000, 25%, $50, card B, mid APR, $3,000, 15%, $60 loan C, low APR, $5,000, 5%, $100, total minimum PIMT, $210. If you have an extra $400 a month to pay towards debt. Snowball method. You'd attack card A first because it has the smallest balance, $2,000. Avalanche method. You'd attack card A first because it has the highest APR, 25%. In this specific scenario, they align. But what if card A had a $6,000 balance and loan C had a $1,000 balance? The snowball would attack the 5% loan while the 25% debt grew wildly, costing you hundreds or even thousands of dollars in unnecessary interest. The avalanche method is mathematically sound, reducing the interest paid over the life of the debt to the absolute minimum. The psychology. Why the snowball feels better now, I'm going to address the objection. But John, the debt snowball gives you quick wins. It keeps you motivated. And here's where the lie becomes a brilliant psychological trick. The debt snowball exploits progress principle, the immense psychological boost we get from seeing concrete progress. Paying off a small $500 credit card provides a huge tangible mental reward. A debt is eliminated. This surge of dopamine helps you maintain momentum and attack the next, bigger debt. The avalanche method, while saving you money, might mean staring at a huge $20,000 loan balance for 18 months with no win. That lack of gratification can lead to burnout and debt fatigue. Storytelling, analogy. The avalanche is like exercising perfectly, saving maximum interest, but the snowball is like having a drill sergeant shouting affirmations every time you finish a tiny set, saving your motivation. The actionable hybrid, the psychological avalanche. We don't have to choose between saving money and saving your sanity. We use a hybrid approach. Do the math, avalanche first, calculate all your debts and rank them strictly by highest APR. Identify the micro win. Scan your ranked list. If your highest APR debt is a monster, but you have one small debt, under $1,000, with any APR, even if it's 10%, kill that small one first. Engage the avalanche. Once that micro win is cleared, taking 1 to 2 months, immediately transfer all subsequent payment power to the absolute highest APR debt remaining. You get the psychological boost right at the beginning to prove you can do it, and then you use the pure math of the avalanche to save maximum dollars. You beat the lie by using its own trick against it. Part 4. The 1% Rule, the Rapid-Fire Loan Decider. Okay, we've navigated the tricky world of credit scores and debt repayment. Now, let's give you a powerful, quick-fire tool to avoid bad debt entirely. The 1% Rule for loans. You are standing at the car dealership or maybe looking at a massive personal loan. They give you a monthly payment and the number looks manageable. They want you to focus on the monthly comfort. Here's what they don't want you to realize. The true measure of a predatory, wealth-destroying loan is the relationship between the monthly payment and the principal amount, the price. The rule: if the monthly payment on an amortized loan, car, personal loan, RV, etc., is 1% or more of the initial principal, you are likely looking at a terrible financial decision. Example. Scenario. You are buying a $30,000 used car. The dealer offers you a payment of $450 per month. Test the 1% rule. 1% of the principal, $30,000, is $300. Your payment is $450. Your payment is 1.5% of the principal. This loan is a terrible deal. It means you have a long-term, a high interest rate, or both. That extra $150 per month is pure financial drag. Why the rule works. The math. A healthy, efficient loan, with a reasonable term and a competitive rate, should have a monthly payment that falls well below 1% of the principal. When the payment creeps above 1%, it's a warning sign that the dealer, lender, has stretched the term out to 72 or 84 months, making you pay interest forever, or jacked up the APR. They are hiding the true cost of the asset in the structure of the debt. The 1% rule forces you to switch your focus from, can I afford the monthly payment, to, am I overpaying for the debt itself? Storytelling. Analogy. If the 1% rule is exceeded, you're driving a car that costs too much, but you're paying for it with a loan that's even more expensive than the car itself. Actionable step. Set the payment limit before you shop. Nick, never shop based on the advertised monthly payment. Shop based on the price and apply the 1% rule. Find the asset price. Say, a $25,000 boat. Calculate the ceiling. 1% of $25,000 is $250. The rule: if any loan payment offered to you is above $250, excluding insurance, walk away. You've just insulated yourself from years of crippling payments. Part 5. Conclusion and motivation. So, what did we learn today? We learned that the debt and credit system is full of invisible ceilings and clever psychological tricks designed to keep you paying more and working harder than you need to. Stop wasting energy chasing a credit score above 780. Focus on your debt-to-income ratio. Stop losing money to debt fatigue. Use the psychological avalanche hybrid to save dollars and boost your motivation. Stop getting ripped off by predatory loans. Apply the 1% rule before you ever sit down with a salesperson. This isn't just about saving money on interest. It's about saving time, energy, and mental bandwidth. The true non-renewable assets of a financially independent person. You have the math. You have the psychology. Now you have the advantage. If you like this breakdown of the invisible traps, hit that like button. Let me know in the comments below. What's the highest interest rate debt you're going to use the avalanche method on today? Your answer might motivate someone else. If you want the next step, How to use good debt to start building leveraged wealth through real estate? Watch this video right here on the Mortgage Multiplier. All right, we've covered the lies of scores, the psychology of payoff, and the quick metric for avoiding bad loans. Now, let's talk about the single biggest source of profit for credit card companies and personal lenders: the minimum payment mirage. Every month your credit card statement arrives. Right there, in bold, is the minimum payment, a tiny, manageable number. Your brain says, "Great, I can afford that, I'm fine." This small, comforting number is the most financially destructive piece of information on that page. It is scientifically engineered to keep you on the debt treadmill forever. The psychology: avoiding cognitive pain. The minimum payment mirage exploits friction aversion. Making a huge payment, say $800, causes your brain immediate cognitive pain because you see your checking account balance drop sharply. Making a small minimum payment, say $50, causes almost no pain and gives you a feeling of momentary compliance. The banks know this. They set the minimum payment intentionally low, often just 1% to 2% of the principal plus interest, to minimize your pain and maximize their profit. The catastrophic math. Here's where it gets really interesting and, frankly, infuriating. Let's assume you have a typical $5,000 credit card balance at 20% APR. If you pay only the minimum payment, let's use a standard 2% of the balance, or $25, whichever is greater. Payment scenario: total repayment, time total interest, paid minimum payment, only 23 years, $7,600 fixed payment, e.g., $125 per month for 4.9 years, $2,300. You read that right. By paying the minimum, you will spend 23 years paying off a $5,000 debt, and you will pay more than $7,600 in pure interest. That's more than 150% of the original principal, just for the privilege of paying slowly. The difference between the two scenarios is over 18 years of your life and $5,300 in wasted wealth. Actionable step: the preset principal payment. You must treat the minimum payment as completely irrelevant information. Calculate the kill date. Go online and use a debt payoff calculator. Plug in your balance and APR and find out what fixed monthly payment you need to make to kill the debt in 3 years or less. Automate the kill payment. Set up an automatic payment for that high fixed amount. You see the minimum payment on the bill, but your bank automatically sends the higher life-changing amount. You use automation to bypass the psychological weakness caused by the minimum payment mirage. We'll finish with the single biggest reason debt exists in the first place, and it's pure, raw psychology: the decoupling illusion. When you use cash, you feel the immediate pain of the transaction. You see the stack of bills shrink. This is coupling. The decision to spend is immediately linked to the physical loss of money. But when you swipe a credit card, you feel zero pain. The money loss is decoupled. It's separated by 30 days, an online statement, and a small future minimum payment. Your brain registers the purchase as free money in the moment of the swipe. The psychology: pain and future self. This is compounded by the fact that our brains treat our future selves like strangers. The person who has to pay the bill next month is not me. So, we happily burden this stranger with debt today. This illusion leads to what researchers call the credit card premium, where studies show people are willing to spend up to 100% more when paying with plastic versus cash. Think about that. You're willing to double your expenditure for the exact same item just because the payment method hides the pain. The actionable cure, the effort conversion method. We need to force your brain to recouple the debt to the financial effort. Stop using money. Whenever you pull out your card, don't think in terms of dollars. Think in terms of hours of work. Calculate your hourly rate. If you make $60,000 a year, your gross hourly rate is roughly $28.85. 50 weeks, 50 hours per week, 40 hours. Convert the debt. When you buy that $300 jacket, immediately think, that jacket costs me 10.4 hours of my life. That's a full workday I now owe to the bank. By converting that dollar amount back into the sweat and time it took to earn it, you force your brain to acknowledge the real cost. The pain of working 10 hours for a piece of clothing you don't need is often enough to stop the impulse purchase cold. Nick, the decoupling illusion is the reason you're in debt. The effort conversion method is the single most powerful psychological tool you have to get out.